Good afternoon, everybody. Thank you for joining. We'll just give it 30 seconds to a minute just to give a few extra people time to join, and then we'll get underway. Okay, we'll crack on, just conscious of time. So good afternoon, everybody, and thank you for joining this post-budget future planning webinar. For those who don't know me already, my name is George Sigley, and I'm a relationship director in the Midlands Agriculture team here at Barclays UK. This meeting is going to be recorded for those who can't make it or wish to re-watch, and we'll get that sent out after the conclusion of today. The autumn budget sent some shockwaves around the country, especially in the agricultural and landed estates space, with the changes proposed to capital gains tax and agricultural and business property relief linking to inheritance tax. I've found since the budget that almost all of my conversations with farmers and rural professionals is either linked to or solely about the aforementioned changes. Therefore, I had the idea to bring together some of the best rural professionals in this area to present the current proposals in an easy to understand manner, but also to reinforce the support that's available to you and your farm business. So presenting on the webinar today, we've got Roy Jackson, Rural Partner at WR Partners. We've got James Goddard, a Partner at Knight Solicitors, Rhydian Scurlock-Jones, Head of Rural and Director at Savills, and myself, Relationship Director at Barclays. We'll run through the presentation that has been prepared in the order of speakers just mentioned, and then we'll come to a questions and answer session at the end. We'll give you a little bit more information as that comes. But any questions you have, if you pop them in the Q&A section at the top of Teams as we get towards the end of the presentation, when I come on, you should see that top of your screen, and we'll answer as many as we can in the time allotted. So without further ado, I will pass on to your first speaker today, Roy Jackson. Roy, over to you.
Good afternoon, thank you, George. So in terms of actually what I'm going to talk about, so I've got 10 minutes, or this afternoon, sorry. I'm just going to touch on probably the main capital taxes, which were updated through the budget. I'm not going to touch on national insurance, and I'm not going to touch on double cab pickups, which obviously have all got an impact on many employers and also actually companies and business owners. So in terms of actually where we got to, in terms of actually those capital taxes and where we are today, the majority of those actually are impacting things from the date of the budget, although there are actual proposed changes coming into play from the 6th of April 26 and 6th of April 27. There are actually anti-stalling rules in play which start from the date of the budget, so it's just to be very aware of that if you're looking at any planning options. So where are we now? So I will go through in terms of those capital gains tax planning options. We'll go through the inheritance tax. We'll then go through some of the pension aspects, and then we'll also touch on actually what might change in there. So those are the points which we'll go through. Next slide, Joe. Okay. Okay. Let's check what slide everyone's got in front of them. Brilliant.
So you've got budget.
Or we have capital gains tax.
You have capital gains tax in front. Yeah. Okay, great. Thank you. Okay. So in terms of where we are at the moment, we've got a landscape essentially such that actually from the 30th of October, we've got this position whereby actually we have a change in terms of the main rates of capital gains tax. And essentially those capital gains tax rates, they've moved now from the low rate essentially increasing from a 10% rate to 18%. And then the higher rate having now increased from 20% to 24%, which is aligned now with where we are in terms of actually those residential capital gains tax rates. The actual annual exemption, that has also now changed. So the annual exemption is also now reduced down to £3,000. Now that is actually less increase than actually was anticipated. So I think that is probably a plus side. We then come on to where we are in terms of actually then business asset disposal relief. Now this is one of the reliefs which is available when you're selling actually your limited company shares, for example, or selling a whole or part of your business or assets associated with your business. Now, what they have done in terms of that relief is actually, until we get to the 5th of April 2025, that relief is still providing a 10% tax rate on the first £1 million worth of gains. And effectively then from April 2025, that effective rate will increase to 14%, and then from April 2026, that rate will increase to 18%. So the saving goes down over a period of time. So for those clients actually looking at actually to sell, actually the earlier they look to sell, probably the better to try and make the most use of that actual reduced capital gains tax rate, because that rate's only going to increase. So if we look at the situation whereby we have a situation with a sole trader that's looking to sell their farming business at the moment before the 5th of April 2025, and what that tax position looks like for them at the moment, if they sold for the £5 million capital gain before 5th of April 2025, they'll end up with 3.94 million after tax. If they sell after April 2025, before April 2026, they'll end up with 3.9, and then that reduces then further down to 3.86. Now, that actually is compounded though if you've got more than one partner, so actually the benefit of selling earlier would be greater, effectively, whereby you have more than one individual. So it's just being aware of that. So what planning options are still available for capital gains tax purposes? Well, largely, they haven't changed. So we'll go on to those now. So in terms of where we are today, what capital gains tax planning options have we got today? So we've still got spouse transfers. Now they can still be very useful when you're actually looking at a situation whereby actually, if for example your spouse may not have used all their tax plans or they've got capital losses available to them, then essentially transferring assets around pre-disposal is still very helpful. That may also be useful in terms of using this £1 million allowance, which we'll touch on later. There's also rollover relief, so that's still unchanged. So if you're disposing of a relevant business asset, you've still got the ability to roll over those proceeds into replacement business assets. So that's relief is still there. And then we've still got business asset gift relief. Now, this might be one of the key components of capital gains tax and inheritance tax planning going forward, where we'll be looking to move ownership of assets around between family members to potentially use these assets. In addition, that is actually available for trust transfers as well, which is under a separate relief. But again, it can be used to provide a deferral of capital gains tax at the time of the gift, with the capital gains tax only being payable in the future when those assets are sold. Another part which is still there as well is actually if actual individuals or sole traders or partnerships or LLPs are looking to incorporate their business, so moving back to a limited company, then essentially they still got that ability effectively to transfer those assets in exchange for shares, whereby they don't have to pay a capital gains tax charge on incorporation. So that's still there for them. We touched on business asset disposal relief, and actually where we've got to in terms of that is such actually that it's really important that actually you consider using this allowance if you are looking at a retirement situation, whether that may be a retiring partner or whether it's a sale of a business. It's just being aware that that's something to consider. So where have we got to in terms of the inheritance tax landscape? Well, this is probably the actual aspects of the budget which sent the most, create the most shock. So we've had a situation now where inheritance tax rules have been largely undisturbed for over 20 years, and significant planning has been undertaken to try to preserve business ownership and succession with that planning in place. But now, essentially, the government has proposed a significant change here, whereby effectively business relief and agricultural relief, which was previously totally uncapped, would now be capped at £1 million per person. And then any qualifying business or agricultural assets which have a value in excess of £1 million per person, only receiving 50% relief. So essentially there'd be a 20% inheritance tax charge on those assets. Now, there are exceptions which enable that tax to be paid over a longer period. So essentially in that environment, that 20% tax charge, if it's land and property and certain qualifying shares, could be spread over a 10-year period, which means that essentially that would be a 2% tax charge for a 10-year period on those relevant assets. But it is just worth noting that essentially if it isn't qualifying property, meaning business property generally speaking, then there would not be an interest-free period on those instalments. There'd be a 9% tax charge on those. So it's just being aware of that and making sure that you make the elections to go down the instalment option if you're going to use that by the appropriate deadlines, because there are periods of time you have to make the elections. So what does this look like in terms of actually the impact on a husband and wife, for example, in this situation? So we've just got an example here whereby actually there's a farming business which is worth 5.85 million, which consists of many aspects to it. And essentially in that environment, we've assumed it's owned 50-50 by husband and wife at this present time. So before, if we looked at their inheritance tax position, we would have had a position before essentially 5th of April 2026, whereby essentially they would have no inheritance tax charge on that business when it passed to the next generation. Post 5th of April 2026, they essentially will now have an interest in that business, and it was based on 5.85 million. So they have 2.925 each. They've then got their £1 million exemption, and then there's 1.925 million chargeable. That is then subject to 50% relief, which leaves £962,000 still chargeable then, which is at £385,000, which is an effective rate of 20% tax charge on that chargeable element. So between husband and wife, you're talking about a £770,000 tax charge across their two estates from nil before the budget. So quite a significant change there for families in that environment. And actually, if the will structured correctly, then that possibly can be deferred until second death, but essentially there's still a significant tax fund needed on that second death. So what have we got in terms of the inheritance tax planning? So where we've got to as a result of the budget, essentially using that example to a degree, if you're a sole trader and you've got a £5 million business, at the present time, then post 5th of April 26, you could have an £800,000 inheritance tax charge on that, taking account of the £1 million exemption, £4 million then chargeable at 20%. What options have you got essentially then to reduce that tax charge in the future? If you can survive 7 years from the date of any gifts because of these anti-forestalling rules in place, then essentially you can take that £5 million business and distribute the value of that business between your wife and then maybe your 3 children to facilitate using that £1 million allowance for all 5 family members, so that essentially that inheritance tax charge then could come down to a nil inheritance tax charge if it's the case that actually they all live the relevant ownership period and live the 7 years after the gifts. We then move on to limited companies. So actually with limited companies, there's a slightly different model here in terms of valuation of limited companies, because effectively shares are subject to potentially a higher rate of discount where you have a minority shareholding. So if again we take the £5 million situation and we move those shareholdings around to be held 25% each, those 25% shareholdings would now be reduced in value essentially from around about 1.25 million down to £1 million with that discounted share price. So again, you could potentially get a nil inheritance tax position if individuals live the qualifying period, and actually there's a 7-year period as well during that period. But it's just worth noting that those children in that situation would need to take out life cover for the 2-year period until their actual holdings qualify for themselves. In addition to that, you might consider life cover for the 7-year period. We then really want to just touch on some of the actual top tips we're talking to our clients about at the moment, because actually it's not the time to panic at the moment because there's a consultation ongoing and things might change here. But in the meantime, what is really important to do is actually establish the ownership of assets, establish the business structure to make sure it's correct to maximise the agricultural relief and business relief on those assets today. Even if it's the case it's 50% relief, it's still no better than no relief. So make sure those are correct and get all the information together so that actually when you come to see your tax advisors, they can talk you through this. If you then look at giving to the next generation, then there's life policies to consider in terms of those who are making the gift and those potentially receiving the gift. And then in addition to that, there's also Consideration as well, if children are young or they're not married or they're recently married, then those prenups and postnups will also need to be considered. And then also there'll be trusts to consider as well as part of this, as part of asset protection, also passing over assets in a more inheritance tax and capital gains tax friendly environment. In terms of individuals' wills, this £1 million allowance essentially is not at the moment proposed to be transferable, which is different to other inheritance tax exemptions. And in that situation, there's a use it or lose it policy. So again, if it's the case it's husband and wife, and actually the wife owns all the farm, then actually moving that ownership of the farm into joint names might be something to consider. In addition to that, if you've got wills in place, then actually make sure those wills are in a situation whereby actually we have a double dipping, which enables tax relief to be claimed twice for certain assets. I'm quickly going to touch out on pensions now because I'm running out of time. So in terms of where we got to in pensions, there's a consultation at the moment until April 2027, whereby it's proposed that essentially pensions, whereas currently they're not subject to inheritance tax, but are subject to a tax charge when drawn down post 75 deaths, or no tax charge if they died before 75. They will potentially be subject to inheritance tax going forward and income tax. So if we take an example here now, effectively whereby an individual has a pension pot of £500,000, going forward from April 27, there could be a 40% inheritance tax charge on that, leaving £300,000 in the pot. And then effectively the beneficiary then draws down on that pension pot. They would then essentially be paying 40% tax if they're 40% taxpayers on that, which would leave a pension pot of £180,000, which then provides you with a situation whereby you've got a £320,000 tax charge, which means the effective tax rate is 67%. It's going back to what the tax rates were in 2015. So we have been in this environment before, but this was, again, something which perhaps was a bit stronger than was expected in terms of those tax increases. So what are we talking to clients about in terms of their pensions and how they should plan for that? Do you use that in lifetime? So do you potentially draw down pensions and then make regular gifts out of income? Do you draw that down and invest it in farmland or businesses which may obtain 50% relief? Consider those options appropriately. In addition to that, the 25% tax-free lump sum is still there, so potentially that could be drawn down, income tax-free and gifted away as long as you live for 7 years. There's no IHT due on that. And then in terms of the income tax, that's still the same as it was before the budget. So if you pass away before 75, an individual potentially can benefit from whatever pension sums are left over after inheritance tax, income tax-free. But after 75, there will be this inheritance tax and the income tax charge as well. So thank you. I'll hand over now to James. James is going to touch on perhaps more the legal aspects of what I've talked about and also go into a bit more detail on trusts as well.
Thank you, Roy. Yes, so as Roy said, I'm actually going to build on his presentation slightly. I'm going to work from the basis of 3 questions, but just building on some of those top tips that Roy gave us there. So I'm going to start looking at three questions. We'll have the next slide, please, Joe. Yeah. So firstly, where are we now? Secondly, where do we want to be? And then thirdly, how do we get there? So where are we now? Pre-budget versus post-budget. So just moving on to the next slide. We are entering uncharted waters with existing tax planning in need of review. Plenty of my clients, I'm sure plenty of you listening, will have done the right thing. You've gone through a tax planning process, and unfortunately, it's going to need looking at again. Now, just in terms of historical background, agricultural reliefs have existed for some time, and they were introduced for food security. Reliefs were designed to ensure the survival of family-owned businesses and farms following the death of the owner, without the need to sell the assets to pay inheritance tax liability. We're now in a position where changes to inheritance tax, capital gains tax, pensions, vehicle classification, and national insurance are all adding to farmers' costs forecasts. And as Roy mentioned, one example of that is the change in agricultural and business property relief, in that it only applies up to a maximum of £1 million of combined agricultural and business assets. Above that, you only get 50% relief, which amounts to an effective 20% tax rate. And most people will easily exceed the £1 million limit. So this is going to capture an awful lot of people. So where do we want to be? Preserving assets. Well, firstly, I'm sure you will want to retain your assets, keep them safe within the family. In doing so, retain your livelihood. You will want to drive your business forward in a tax efficient manner. And last but not least, planning for the next generation. So how do we get there? Planning ahead. There are 6 suggestions there, which I will elaborate on. Firstly, avoid a knee-jerk reaction. Roy has given you some examples of how to save tax and share ownership and all the rest of it. So there are options for you. 2, what are you worth? You will have a vague idea of what your assets are worth, but there's of course a difference between book value and actual value. And the first question that an accountant or we as lawyers would ask you is what are your assets? What are you worth? We need to know that in order to plan for you. 3, who owns what? That sounds really obvious, but you'd be amazed the number of times I've taken on jobs for new clients who told me what they own or what they think they own. I've then gone to Land Registry, downloaded the title registers to find that they don't own it. It's got a previous partner named on the deeds, or it's owned by a previous generation. So sometimes there's some surprises. So have a look at what you have in terms of title and what does it say? Is it correct? What agreements do you have behind that? What do your accounts say? 4, who is entitled to what? Presumably you've made provisions in your wills. There may even be some pre or post-nuptial agreements. So it'd be useful to know what the current position is and what you want it to be going forward. 5, await the outcome of the consultation in January 2025. The devil, as they say, is in the detail. So we do need to see the outcome of that in January to advise you fully. And lastly, number 6, again, this sounds really obvious, but discuss matters as a family and consult your advisors. Have you sat down as a family with the next generation, perhaps even the generation beyond that, to see what you all want to do? Does everyone want to continue farming? Do you want to diversify? It's really important that we know that and understand that in order to advise you. So options to explore: ownership review. So just moving on to the next slide, I mentioned there about checking your titles, and I've given an example here. If you were to take a title register, the first thing to check is the proprietorship register. That will show the class of title and the names of current owners and contact addresses for Land Registry. It will also contain, depending on the ownership, a restriction. And perhaps the most common one we see is at the bottom of the slide there: no disposition by a sole proprietor of the registered estate under which capital money arises is to be registered unless authorised by an order of the court. That is commonly used where people own property jointly if they're what's known as tenants in common with defined shares, or where there's an underlying trust. So if that appears, one of our first questions will be, what's the structure behind this? So moving on to the next slide. Benefits of joint ownership. So Roy's given some good examples of this. I'm just going to give one that's taken from the government website that sounds fairly rosy. 2 people who jointly own a farm will be able to pass on land and property valued up to £3 million to a child or grandchild tax-free. How's that made up? Well, that's made up of £1 million where they combine their standard £500,000 tax-free allowances, £325,000 for their nil rate band, and £175,000 for their residence nil rate band. And then on top of that, the £1 million tax-free allowance each for agricultural property inheritance. But be warned, what the example doesn't tell you is, and as Roy has mentioned, any unused £1 million allowance will not automatically be transferable between spouses and civil partners. In addition to that, the residence nil rate band is tapered away for an estate worth more than £2 million. So not all married couples will benefit in the example shown above. In terms of action then, consider a transfer of that £1 million allowance to a spouse during your lifetime so they can use the allowance, and review your wills so as not to waste that £1 million allowance. So other options to explore: lifetime giving, trusts and other arrangements, and how to document them. So firstly, gifts. Changes in the budget apply to gifts made on or after 30th of October 2024 if the donor dies after 6th April 2026. The general principle with capital gains tax remains the same in that there's no immediate charge as it can be held over on a gift, but there will be a large tax bill later if the farm is sold. And currently, when an individual makes a gift to another individual and survives a further 7 years, the value of that gift falls outside their estate for inheritance tax purposes. Pending that 7-year period, the gift is known as a PET, potentially exempt transfer. In addition, where the individual does not survive the gift by that 7-year period, but survives it by 3 years or more, then taper relief will apply. And agricultural property relief may still apply if certain criteria are satisfied. It's therefore really important to consider age profile if you're considering gifts, because a transfer in later life could lead to liability for capital gains tax and inheritance tax charges. The other thing you need to consider if looking at gifts is living arrangements and the use of the house and the land, because if any benefit is retained from the property that's been gifted during a lifetime, that is ineffective for inheritance tax. Now, historically, the gift on a traditional estate of the house would need to be subject to a lease to commercial rent and certain other criteria to avoid being ineffective for inheritance tax. Now we've got the added issue that the land needs to be considered as well, as that won't automatically benefit from 100% relief as it once did. Now, gifting land to family members may prevent a sale to fund inheritance tax, but, and a word of warning, with multiple owners, the need to document exit and third-party interests increases. You need to consider protection for the relevant entity. So in the partnership scenario or the shareholders company scenario, which Roy gave, you need to make sure that you've got adequate agreements in place which will govern ownership and the running of the farming business. And then lastly, asset protection. Now, this is more financial advice than legal, but it's something Roy also mentioned, and it's important to consider because a policy can either be for a 7-year period to cover inheritance tax if that PET, as I just mentioned, fails, or for the entire potential inheritance tax liability if no gifts are made and assets are retained until death. So that is an important option for you. So just moving on, prenuptial and postnuptial agreements. Now, many partnership agreements or shareholders agreement will stipulate that if a partner or member is married or gets married later on, that he or she has a prenuptial or postnuptial agreement in place. So what are the benefits of those agreements? Well, a court must give appropriate weight to the terms of a nuptial agreement when exercising its discretion under the Matrimonial Causes Act, so in the divorce scenario. Whilst nuptial agreements are not necessarily binding, as I say, a court will give weight to them, so they are most definitely worth considering. The other point to mention is that farming divorces often involve what's known as interveners. So to give you an example, grandparents who may own part or all of the farm. This then leads to one side of the family effectively paying 2 sets of legal fees, one for the person getting divorced, the other for the grandparents. So with these agreements, parties can make it clear in advance that certain property is non-matrimonial and will not be shared during the marriage or on divorce. It will also allow you to protect business interests and prevent disruption to the farming business on the future breakdown of the marriage. So, and the point there really is spend some money now to save a lot more money later on with a disagreement. So on to the next slide. Wills and trusts. So do review your current wills, particularly where there are relievable assets given the change in allowances and rates. Consider flexible wills, for example, discretionary will trusts, where assets can be appointed to potential beneficiaries at trustees' discretion. Alongside that, you can have a letter of wills, a letter of wishes rather, which will help direct the will trustees. But, and it's important to mention this, getting the appointment of the trustee correct is really important. If it's a member of the family, it may lead to a dispute within the family. There may be scope for putting 100% relievable property into trust with no immediate charge to inheritance tax prior to 6 April 2026, where you're prepared to accept an effective inheritance tax of up to 6% on the 10th anniversary. There may also be an inheritance tax liability when assets are passed from the trust to the beneficiaries too, but we are awaiting the results of the consultation in January, so let's just get the detail on that. Also bear in mind that with gifts to trusts now, you should weigh up the cost of potential capital gains tax liability against inheritance tax liability. Should you gift now, or should you let the asset pass on death? Also bear in mind with trusts, you've got the setup costs of those. They need to be registered with the Trust Registration Service. There will be annual tax returns, charges for the trust deed, and of course the transfer deeds if you decide to transfer the property into that trust. So just moving on to the next slide, hopefully that's given you various things to think about. But just to conclude, some do's and don'ts. So do review what you have. Do discuss as a family what you want to do. Do seek advice, and don't panic. Thank you.
Good. Well, good afternoon, all. First of all, I'm going to cover three topics. First of all is a supply review. So look at the current market, look at market values, and then some strategic considerations to think about post the budget. So in terms of looking at the detail of farmland supply, if I show you the next slide, you'll see some of the detail going back to 1995 of the amount of acres in thousands that have been advertised over the years. So you'll see in the 1990s, very high land supply. And then really since the year 2001, quite a bit lower in terms of land supply. And essentially that's constrained the market and added to value, which I'll talk to you a bit later about. But in 2024, 23, 22, we've seen an increase in land supply, nothing like the late 1990s, but definitely an increase in land supply and also the number of farms that have been sold. That gives rise to more opportunities for people in the market. But if we look at then the next slide, I go into a bit more detail for you. So this is looking at the average size of a farm as well. So not just the supply, but the actual size of the farm. So we've seen a slight increase in the size of the average farm coming to the market in the later years, but obviously less in size than average in the 1990s. In terms of supply forecasts, we see there being more land coming to the market in 2025 and probably 26. And I think that was going to happen anyway. So not essentially a direct consequence of the budget, but that may add to that land supply change. So if I then talk to you through the next few slides, we're looking at land value, and anyone knowing about economics knows that greater supply may have an effect on reducing values. But let's look back a bit. So land value here, we're focusing on prime arable average across Great Britain. So as you'll see, there's been probably 2013, 2014, quite a spike in values at that point, but a bit more of a plateauing of values after that. Then in 2021, 2022, we saw quite a lot of increase in land values, especially on good arable land values, to probably a plateau at present. And averaging always does hide the highs and lows. And so, there have been great regional variations in land values paid this year. Some areas highly valuable, other areas struggling to sell. But if we look at the next slide, please. We'll see this as by different land types. So a bit more detail for you. So we've got prime arable in the green at the higher value, and then you have poor livestock as the lower. You'll then here see where the 2008 economic crisis had an effect on land values, but also Brexit and how there may have been greater confidence in more recent years, but that certainly plateaued off. And what we're seeing, post-budget is, well, it's too early to tell yet, but there is likely to be a softening of land value. That is not likely to be dramatic. Land is still a relievable asset, and we must remember that. And IHT has not really been the main driver of most purchases. A lot of rollover relief has been increasing land values, but also demand from amenity buyers and business, farming expansion has been the main driver. So that's land value, likely to see some land value decrease and also more supply next year. So looking at budget considerations. So let's look at some strategizing, but also some of the impacts of the budget. So we're looking at what was the sting after the budget was the hit on delinking payments reduction. So a 76% reduction in BPS payments next year for the first 30,000, and then a cap on that. So that's a big surprise for many farmers that is entirely unbudgeted. And you'll see the graph on that showing, obviously the larger farms have been hit worse. And let's take a couple of examples on the next slide for you to see how that affects some farmers. So just on in terms of detail, so if you were earning 100,000 in 2020-22 in BPS, well, the anticipated payment you'd have budgeted for was 41,500, but the actual payment, is 7,200 next year. So quite a massive decrease of 82% on larger farms. But if you were a more average farm, £20,000 in 2020-22, again this year, 10 grand, now down to 4,800 next year. So a 52% decrease. So again, quite a lot of decrease. And that's likely to affect cash flow, but also investment decisions. But it also may see the driving of greater SFI applications. And I think what's important to do is look at what's out there available in a positive way, is that the Future Farming Resilience Funding is still available for grant-funded advice in setting up an SFI project. So that's worth looking into. So now let's turn to a few more budget points. APR, let's look at the good news. Well, APR is going to be extended to public sector environmental agreements from 6th of April 25. So that essentially is for environmental use of land that it wouldn't necessarily been seen as agricultural use in the past and may not have got agricultural property relief or business property relief. So that's good news to a certain degree, especially for those that are looking to do more biodiversity net gain, etc. Projects. And then also, interestingly, maybe quite a change to landlord and tenant strategy going forward is actually having agricultural holding act tenancies still in existence. The pre-September 95 ones still attract 50% agricultural property relief and will have a depressed value as well. So actually doing a surrender and re-grant or paying for vacant possession of a farm that's subject to an agricultural holding act tenancy may not really be in a landlord's strategy going forward. So maybe some deals scuppered in that change. So let's look at the next slide. Here I've looked at average land values and where is the budget going to have an effect? Well, if we look at average land value, 8,250 an acre across the UK as average land value, well, you only need 121 acres for APR to come and bite you. And so that doesn't even take into account the farmhouse, the stock that you might have, the cows, the grain in the store, or indeed machinery. So I think that is a big hit. I think that is going to create a lot more conversations. So if we look at the next slide in terms of my concluding thoughts, there's going to be a need for farms and estates to rebudget, not just for the year cash flow, but much greater forward thinking, working together with their accountants and lawyers and land agents in a roundtable way, looking at the pets that's been mentioned, but also being careful of reservation of benefits and getting advice on what level of rents may need to be paid if there is a reservation of benefit. But farmers and landowners were incentivized in the past to own assets until their death. But now it's obviously much clearer that conversations need to be having a lot earlier. And we're advising on value in terms of strategic advice, so not producing long, lengthy reports, but producing very helpful spreadsheets and ranges of values to support farmers and landowners in understanding what they're worth, because often you undervalue yourselves and what your assets are. We're also assisting on 10-year tax charge budgeting, so looking at what might be relievable and what might not be as relievable under 10-year tax charges, so assisting in terms of budgeting that hit when it comes. And then also looking at HMRC, interesting in terms of probate valuations in the past. There were, everyone essentially ignored the machinery and stock, etc., because you got 100% relief. Well, going forward, there's going to be a lot of focus on how much silage have you got, how much is that worth, etc. And I don't, believe that HMRC yet have the skill set required to consider that. So I think there's going to be quite a lot of change needed going forward in terms of training and how we deal with that in terms of our advice to you. But stepping back, let's not rush things. As we've said, let's wait until the consultation in January and things are a bit clearer. But now is a good time to start thinking about your asset base. Isn't it near future the time to dispose of low-income assets that are worth quite a bit and maybe focus on assets that are worth the same, but provide you with higher income? That may be relevant to some and not relevant to others. But we are also facilitating a lot of succession discussions and assisting the next generation really in understanding what their responsibilities are, especially if they end up with property and assets and influence at an earlier age. So we're all here to help if we can. And I'd now really like to pass you over to George. Thank you very much.
Thank you, Rhydian. For anybody who didn't notice at the start, and we've had quite a few people more join since the start. So I'm George Sigley. I'm a relationship director at Barclays. We go to the next slide, please, Joe. So you might be thinking, why Barclays on here? Why is that important? Well, Barclays, we can trace our history in agriculture back to 1744. So we've got over 280 years experience in this sector. We've got relationship managers and directors across every county in England, Wales, Scotland and Northern Ireland helping farms on the ground. And it's our job to get to know you and get to know your business the very best way that we can and build a relationship of trust and respect, because we want to work with you to help implement the changes that your tax and legal advisors, that Roy and James, for example, may suggest. And we're going to play quite a key role in that when it comes to changing charges, moving debt around, etc. We go to the next slide, please, Joe. So what shows on the screen now is UK bank lending figures to agriculture as a whole. So this is UK Agriculture PLC as such. So based on April 2023 figures, most up to date we've got at the moment, agriculture lends around about £18 billion worth of debt, offset at around about 10 billion of credit balances. Now that debt figure is down from a 2021 peak of 19.6 billion. It doesn't show a truly accurate picture for that year, because we had sort of pig, poultry, cropping sectors where debt rose quite significantly, but in sectors such as dairy, we had historically high milk prices, quite a cash positive year, saw debt come down. Anecdotally, a greater number of farmers retired and left the industry in 2023 compared to those previous 2 years as well. That will also contribute to that drop. We go to the next slide, please, Joe. So this shows a Kubler-Ross change curve. I think we've heard so far from Roy and James especially about some potentially fairly eye-watering figures that could, important word, could be relevant to your farm or your client's farm with inheritance tax and capital gain tax changes. I think this change curve sums up where we are right now. We've gone, or we're going through, the shock and denial stage. Frustration has been shown and clearly demonstrated with the march in London a few weeks ago. I think we're now sort of moving into the territory of how can we work within these parameters and the best way to move forward. And I think it's safe to say that the three previous speakers, and I echo that at the moment, the message is very clear here. We've got to plan, we've got to prepare and take advice pending moving forward. Next slide, please. Yeah. So Barclays are here to help. We want to help in every way we can. We want to work with you, your accountant, solicitor, consultant, land agent, and we want to be part of that management team, that group of trusted advisors, and work together as one. As an agricultural team, we have a clear mandate to grow. So we're here to support you with your growth ambitions, but also to support the continuity of your farming business. So our lending criteria in that ilk has only eased in the last 10 years that I've been associated with Barclays. And as responsible lenders, we're keen to grow and get to know you and your business. With that in mind, what do we think of when we look at a lending proposal? Well, it's three key areas. There are other bits, but these are the three key areas, and it's character. So who are we lending to? What do you do? Affordability, pretty straightforward. Can you afford it? And finally, security. Can you secure it? Next slide, please, Jim. And that summarises where we are. We Barclays and banks, I think, will be very much sort of almost reactive to advice given. We are not advice givers, but we certainly want to work with you to try and get this done as quickly as possible when that advice lands. So I think to summarise, I would suggest, James said, avoid any knee-jerk decisions. Speak with your professional partners and play out scenarios of what could be your capital gains tax or inheritance tax exposure as per your current business structure, and what would happen if changes were made to limit that said exposure. When we know the outcome of the January 25 consultation, I'm sure all four companies presented on this webinar will be more than happy to support you and your family with whatever queries you may have. And thank you all for listening. So we will go to some questions now. You've got a couple of ways that you can ask. You can see my telephone number on the screen now at the bottom. If you want to text me, if you want an anonymous question, please do so, and I'll read it out with all the time that we have left. Alternatively, if at the top of the screen you can see there's a Q&A button. If you click that, a little pop-up on the right-hand side will show where you can type in your question, and again, we'll get through as many as we can. If the speakers want to jump back on so we can see them, I've got a couple that have been texted through before the call that I'll start with just while people are having a think. So the first one, Rhydian, I'll send to you, if that's okay. It's, are there more non-farmers buying farmland? And if so, do you think that trend will carry on, given the, well, albeit potential less relief available in inheritance tax terms?
Thank you. Well, generally, there's been a very strong farmer market, and that farmer market is not just about expansion. It's about rollover relief as well on land that has been sold for development, and so in some areas there's obviously a strong amenity buyer profile, and so I think that will continue. It's a tangible asset. It's an asset that people enjoy using. It's not just about farming and not just about income producing, but I think the backbone is agriculture and land use for food production, as well as environmental use. So I don't see a significant change post-budget in that profile as such. Thanks.
Okay, thank you. So next question, I think I'll answer this one myself, is would you sell and complete before April 26, or tough it and see how it goes, noting the changes to the proposal? I think an answer to this is going to be very much every farm is different and every situation is different. I think it's based partly on what's your succession. If you've not got any, you'd probably be considering looking at it now if that's on the cards. If it hasn't, there's no reason for you to stop farming. I can't give, or I don't think anyone on this call could give, yes, it's right to go before or after. I think if we all went before, we quickly run out of farms, and the market might get might be saturated quite quickly, Rhydian. You might want to keep your eyes peeled. But no, I think it's very much, it's an individual question to an individual answer. My advice would be speak to your advisors. What will be your position in terms of capital gains? Well, those changes have already come in, so there's no avoiding that as such. Inheritance tax, yes, it's 26, so you've got a bit of time, but speak to your advisors, see what's right for your situation, and take it from there, really. Next question, should I move the trading or stock element and machinery element out of my farm partnership and go into a limited company? Would that have any benefit on the inheritance tax position from our current farm partnership? Roy, I'm going to come to you first on that one, if that's okay.
So generally the question would be, actually, is that the right decision actually commercially and practically for your business? That's the first question. And then in terms of actually then ascertaining whether that has any impact on your inheritance tax position, you need to look at actually what the share ownership of that company is going forward, and actually who owns those shares. Because if the same owners of the business before you transfer to the company are the same owners of the company, then effectively you're probably in a status quo position. And in addition to that, if when you transfer assets into a company and it's not the same owners of that company ask for the transfer of the assets to that company, there's potentially a gift involved. And there's also directors' loan accounts, which is a big thing to be aware of. Is directors' loan accounts do not qualify for inheritance tax relief. So individuals who are sat there with big directors' loan accounts may wish again to review those to consider whether they convert those into some form of a qualifying share for business relief.
Okay, thank you. James, is there a legal standpoint we need to be concerned on that point?
Well, only to say that if you're transferring to another entity, that you want an agreement to govern how the business is structured going forward, what happens on exit, and that kind of thing. There's a whole list of things you can cover whether you're in partnership or limited company. And yes, there's an expense to that, but if you're going to do it and it's a tax-driven decision, then you should do it properly, because this is all about long-term planning.
Okay, thank you. So first question from the Q&A section. So if you have borrowing secured on a land parcel, would the gifting of the parcel and the borrowing incur a capital gain tax cost on the gifter and stamp duty on the receiver? Roy, James, over to you, gents.
So in terms of gifting assets which have got debt secured on them, then effectively that can be deemed consideration. So that effectively can create a tax charge for capital gains tax on transfer that potentially reduces the value of the pet. So that's one thing to note. So there could be a capital gains tax charge if there's debt associated with it. And then in terms of stamp duty is notoriously complex, but essentially, yes, a stamp duty charge may apply where there's transfer of asset and there's debt associated with that. There are certain provisions within partnerships which facilitate actually a relief from stamp duty, but that again needs to be considered very carefully. If there was also then a potential change in the structure of that partnership within a 3-year period post-transfer, then there's potentially a stamp duty charge as well to be aware of. So it's not just stamp duty when you transfer, but it's actually potentially events afterwards which could also trigger that as well, to be careful.
Okay. Another one, if you have borrowings on an asset, is this taken off the overall value for IHT? So is it netted off?
So there's probably a number of factors to consider in that situation. So when you're looking at an inheritance tax calculation, you value an interest in a partnership. So actually, you'll look at actually how they're presented in a set of partnership accounts. Is it related to real property, or is it actually in relation to general capital? That would define then where that deduction comes. And then essentially, if it's not in that set of accounts, then you need to look at actually what purpose that debt was originally, to consider how that's deducted in terms of computing the inheritance tax at the end of the day.
Okay, thank you. We've just got one more question at the moment that's come through on text. Rhydian, I think I'm going to come to you first on this one, if that's okay. How would assets be valued should the owner pass away? Is it a HMRC appointed valuer, or is it a local valuer that the estate can choose?
No, so on the date of death is the valuation date. So that's the critical date, and you can obviously appoint your own valuer post the death. The executors or their private client lawyer would instruct us, and we would visit and take all of the information in detail and undertake the due diligence in order to provide that Red Book valuation report that would be used, and that would analyse agricultural property relievable assets as well as assets that aren't relievable for agricultural property relief. So we put different values on elements, and so you're very much at liberty to choose your own. And should HMRC want to query that, then they are likely to appoint the district valuer to come and assess maybe the value of the farmhouse or any other aspect that they want to look at. And I often would escort the district valuer around, but that's often a year or two post death. And then we may have a negotiation over certain elements and points, really. But I think it's all about planning ahead. So hopefully we may have been involved before the death would be our suggestion at the moment.
Okay, thank you. One more question come through here. Will a bank lend to pay inheritance tax? Yes, it's subject to application, but yes. There are, as Roy mentioned, potentially ways that you could pay it interest-free, because we're not a charity, we will charge you for it. So definitely work with your advisors that way. But yes, if you need help, if it's the right thing, we can afford it, secure it. Yes, we can. There are no more questions at the moment, so I would propose that we pretty much leave it there. We're almost on time. So James, Roy, Rhydian, thank you very much for all of your help today. Joe, thank you for your help in the background, and thank you everyone for listening. As I say, the call was recorded, so it will be put out afterwards if you want to listen to it again. But thank you, everybody, and Merry Christmas and Happy New Year.
Right, thanks, George. Take care.
Thank you.
Thanks, James. Rhydian. Best.
Bye.
Christmas.